before we go drill in further, we've talked about how they're challenging the mutual funds, unit trusts, etc. Is it likely that one day, long down the line, that we will see this industry big or as perhaps bigger? And I suppose one of the key drivers there is, are we seeing institutions come in, the large institutions come in and start taking positions in exchange traded funds or notes, whatever they might be?
So there are a number of questions in there. I would say that people are looking to rationalize, where should I spend my risk budget to look for alpha? So if they can find active funds or other things that are delivering alpha, they're still going to use them. What they are doing is saying, when I can't find a good active fund or I can't generate alpha myself, I'm going to go to ETFs. If we look at the users of ETFs, we are seeing that ETFs are a unique product that appeals to both institutions and retail clients. So depending on the market, the split between retail and institutional is pretty significant. In the US, it's probably 50% institutions and 50% retail. Outside the US, because advisors are typically paid to distribute other products, not ETFs, they tend not to really speak about ETFs, and therefore you find that the split is more 80% institutions and more likely 20% retail. That varies because we are seeing, as regulators in some markets like Australia is forcing advisors to move away from receiving commission to distribute products to being fee-based advisors. We're seeing very significant growth there, where I was out there 4 weeks ago, and even journalists I would meet would say, you don't need to explain ETFs to me. I already use them in my self-managed super account, which is a long-term saving product. So I do think that learning about ETFs, being educated about them is a challenge. As financial advisors move to fee-based advisory, they tend to embrace them more openly than when they're being paid to sell other products.
Largely because of performance, because suddenly performance becomes so much more critical. If you're being paid up front for selling a product, you got your money in your pocket.
Yes.
With regards to the flows, we're talking about mutual funds, net sales globally, negative of mutual funds, negative $4.5 billion, net sales of ETFs, up $38.4 billion. We're talking about the users of ETFs at this point in time. We've seen massive liquidity flows through stimulus packages on a global level. How has this affected the overall liquidity scenario? And would you say that because ETFs have been taking a lot of the limelight away from the active managers on a global level, that we are starting to see more interest here, and therefore active managers and the overall management scenarios on a global level is going to receive less flows going forward?
Well, I think when managers aren't delivering alpha, they're less likely to get inflows. So if you look last year, the numbers are even more pronounced. Globally in 2010, the net sales of mutual funds were minus 132 billion, while the net sales of ETFs were plus 170 billion. So I think people are really looking at, can I find products that are delivering alpha? And if I can't, I'm quite happy to use ETFs because they cover more benchmarks. I can buy them anytime during the trading day. I think the other challenge has been just that volatility has been at different levels. And when volatility goes up, people want to be able to react, and they will use ETFs more. Also, when correlations go up and it's harder to differentiate between individual stocks and bonds, they will also use ETFs more. So I think there's a number of things going on, but I do think that the mutual fund industry will still continue to be successful, but I think closet indexers will find it harder to be successful longer term and gather assets. So I think people are differentiating and looking at spending the risk budget more wisely.
And in essence, there'll be two large industries here. One, the mutual fund unit trust, the other one, the ETF, both within locally, it's the collective investment schemes is their overarching body.
Exactly, and you can think of it as the barbell approach to investing. People want alpha where they can get it, but where they can't, they look for low-cost beta, and they balance out where and how they should invest based on.
We're seeing a lot of the innovation coming through we certainly in the local market started off with the Satrix 40, New Gold. We've seen some ETNs coming in Africa on the commodities and the like. Internationally in the US, there's inverse, there's geared funds. Inverse make money when markets are falling. Geared funds give you, this is going to be the natural evolution in South Africa. Are you going to end up in that space as well?
Well, I'm not sure. I think there has been some reservations about the leverage in inverse products because it's very important to understand how they work. So they might say something like, 2 minus an index performance. The challenge is they rebalance each day. So what you have is path dependency and compounding happening. So beyond a day, you cannot predict performance. So there were cases where someone would think, great idea, I'm going to go 2 or 3 minus an index. They would go away, think they made money, go back and sell the product and actually be surprised, which isn't always bad, but disappointed because they didn't receive the returns they expected. And they complained. And so we saw in June 2009 that the SEC and FINRA, two regulators in the US, said these really aren't appropriate products for retail, because retail isn't monitoring their portfolio daily, as you would need to use these products successfully. They're really more concerned about long-term cash preservation. So there are people now who find these products useful, but it's the more sophisticated investors. So I think I would not be surprised to see that the regulator moves pretty slowly on leverage and inverse. I think there's other products that are very useful, like more multi-asset class strategies, more fixed income, that I think are well suited to retail and institutional clients.
Well, let's now delve into the biggest inflows and outflows. So in other words, the hottest and the coldest ETFs, of course, given the theme of the show. iShares DAX, we've seen massive flows going through there. In fact, year to date, experiencing the best net inflows. Debbie, what is the underlying reason for this?
Well, I think what you're seeing is that investors are looking at where they invest, and Europe is a case where there's concerns about many countries, and so what you're finding is investors right now, instead of going into sectors or many of the countries they have concerns about, are going into markets like Germany because they see that market as being a better environment for the economy and performance in the long run or short run. And so you are seeing people looking at political and economic news that is coming out and reweighting their portfolios appropriately to address their concerns, moving out of some of asset classes and moving more into some that they feel will perform better over the shorter, longer term period. Because some people use ETFs short run, some hold them longer. I guess the general trend that we see is right now investors are also concerned about broad US market exposure. And in the US they're moving into sectors more than broad US. And the general trend right now is moving into developed international markets. A little bit of money is going back into the emerging markets. Many people were concerned after the events in the Middle East, North Africa, but I think it drives home the point. It's very important to understand benchmark construction. So if you think about MSCI Emerging Market Index, the only Middle Eastern country in there is Egypt. So if you're concerned about the Middle East GCC, that's not part of that index. And so we've seen recently that investors are going back into, in May, the emerging market index, but we're also seeing investors going into Russia. A little bit of money's gone back into South Africa last month, the US listed product. We've seen investors going into Korea, Taiwan, Brazil, and so they're being more selective about countries. There's also
as opposed to buying into a mix of countries,
well,
they're looking selectively at specific countries.
Exactly. So now ETFs are really a building block. So rather than just buying the broad emerging markets, they're saying, I really just want Russia, or I'd rather overweight Brazil, or I want to go into Korea. We're also seeing a search for yield, so high dividend paying stocks. The concern about inflation is having people look at real estate sectors. We've also seen investors looking at inflation linked bonds. They're looking for high yield bonds, emerging market bond indices. And then in commodities, it's been an interesting mix of stories. So we've seen people take profit out of their gold holdings. We've seen investors think that the energy prices are going to go up in the short run because of what happened in the Middle East, North Africa, and they did. We're seeing investors being concerned about agricultural commodities because we've had droughts in China, floods in other crop producing countries, and clearly demand for food is going up. So you've seen interest in agricultural commodities, thinking prices would go up. And then also looking at commodities as uncorrelated asset, inflation hedge, and flight to safety. So there's a lot of stories behind what's happening, and you find that because people can use ETFs in so many different ways, how and why they use them and when they move.
And that's exactly the beauty of them. Food prices rising, you can go get an agri one, and I want to bring it into South Africa because we don't have an agri one in South Africa. A small market, our biggest is New Gold, 16 billion rand, Satrix 46.2 billion, very, very small market, 10 years old or something, but we're starting to see stuff coming through. We've seen the commodity ETNs, we've seen the multi-asset class ETS coming out as well. That's the path we're going to follow. This market's going to mature. How do you see our market in let's jump maybe 3, even 5 years down the line?
Well, I do think that it's going to mature. I think, there was a conference today that was quite interesting. And so if you contrast the ETF industry, which has existed for 10 years, has 33 billion rand, the unit investment trust or collective investment scheme took 30 years to get to that level of assets. So clearly ETFs are doing well. I think that the retail investors here, though, want products that are more balanced in approach. So they're looking for someone to help them with asset allocation. And so we're starting to see that financial advisors like yourselves are embracing ETFs. And I think that trend will continue. I think now that exchange controls have changed, you're seeing investors also look at, should they look at investments outside of South Africa that might provide investments that you don't currently have here? But I think the minute that people here see that there's an opportunity for something missing, product innovation is something that I think will happen locally.
Debbie, do you get the sense that only once an event occurs, or when we start seeing fundamental changes in the real economy and in the equity market, does then the ETF market starts responding, or do you find that the ETF market responds prior to market moving news? Which is pricing it? Do you get what I'm saying? So who's actually moving the market here? Who are the market makers?
Well, I think a lot of the trends that happen with ETFs are due to people seeing movements in the markets, right? Others, I think that people have good ideas, and because people see them moving, they may also follow and use the ETF to do so. So it's hard to say what drives what, but I think most of it is people see news, they want to be able to react. A great example would be, when the terrible events happened in Japan on March 11th, the markets went down a lot. By March 15th, many investors felt that, one, the location and size of what happened would be more similar to the Kobe event. So they wanted to come back into the Japanese market. You saw that ETFs on March 15th in the US had their highest ever trading day. So in terms of dollar amount, number of shares, and was the second most actively traded stock in the US. And so investors used the ETF as a tool to get back into the market. So clearly it was news, information, and how do I react? And ETFs just make it easy because you don't need foreign accounts, you don't need special custodians, you don't need permission to invest in these markets. And they trade and settle.
Right there in your brokerage account, click, click, you get that diversification.
Yeah, so I do think, I wouldn't be talking about ETFs since 1997 if I didn't think that they really were a good product.
Well, we've run out of time, but Debbie, where do you see the South African market going? Which ETF do you think is going to be most popular, and what kind of demand are you seeing on the ground for South African ETFs?
Well, I think that, as was pointed out here, I think that there is demand for the products that are here, but we're also hearing people ask for products that don't exist here and they can see on other exchanges. So I think people will slowly start using products outside of South Africa, but I also think that we'll see the growth in the products in South Africa to address the demands from clients, and multi-asset class portfolios that use ETFs as building blocks, I think will be one of the ways going forward.
Simon, hot or not, ETFs for you?
Oh, without a shadow of a doubt, the best thing since sliced bread.